Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 28th of March. It's still 2023, and we have a split in the market that continues. What we're seeing here are three charts of the NASDAQ futures, the Russell futures, and the S&P futures. What's unique? We're going to take a top-down approach as we look at the sectors in tonight's video. What is going on? Let's start over here with the Russell. When the financial crisis, the regional bank crisis took place, the Russell had exposure to a lot of small cap regional banks, and that took the Russell straight down, along with the XLF. So we'll come to that shortly, but the XLF is the main driver, and the KRE, which is your regional banks, is what took the market down. However, money flowed as the equity market saw declines into the bond market, we'll look at TLT, and into gold. But it also flowed into technology, or let's look at XLK, or the NASDAQ. So at the same time the money flowed out of the Russell and the small banks, regional banks, it sought safety with technology. And that boosted up the NASDAQ, XLK, and some of the other major technology companies. That includes our monsters of tech. Well, the S&P has exposure to financials, which pulled the SPY. So that was pulled down by the XLF weakness, but it had exposure to technology shares and technology sector stocks, which pulled it up. So XLK and technology. So where are we and what's the point? The S&P is not here where the NASDAQ is, nor is it here where the Russell is. It's right in the middle. And that is a split because the K pulled the S&P up at the same time the financials pull the S&P down. What might be going on and what's happening in today's session and the day before? We're getting a little unwinding. And the unwinding is a little more bullish for the financial sector and financial stocks and the Russell. But it is bearish as we rewind the rally. And what happens to the S&P? Still stuck in the middle with you. Now, what does this mean for sectors? It means to be careful and trade your stocks within the sectors that you're actively trading your positions. Let's just see the split as it goes from XLF on the left and XLK on the right. What are these? And we'll zoom the perspective into around October. So XLF is financials, and that's your regional banks are a part of it, but also Goldman Sachs and Morgan Stanley, Bank of America. The big banks still fit in the financial category. XLK is technology. So this is the decline. That's the rally. If we're seeing an unwind, the next potential movement of the financial stocks or the XLF is a rebound a little bit higher. That could correspond with a sell side or sell swing in the technology shares and technology sector. And as of yesterday and today's session, that's what's happening. We have another split with the Russell flat on the session and the S&P flat as can be. So is the NASDAQ, or so is the Dow. It's the NASDAQ that was not so flat. In fact, the NASDAQ spent the bulk of the trading session red, going down over 1% before it rallied. And that is in large part because how the markets perceive and how they trade with the monsters of tech. In the S&P, generally speaking, these are the technology sector, and they're down, they're pulling down. Think of a hook. It's hooking the downside of the S&P. But over here is both energy, industrials, which is strong in today's session, and some financials. So all of these were contributing to the upside of the S&P. Think of it as hooking it to the upside. Hook just means pull it right in the middle. And of course the end result was flatness in the S&P in a range trading session. The Russell has no monsters of tech. There's no stock big enough to influence the whole Russell index. They're about equal. But in that NASDAQ, there they are. There's our beloved monsters of tech with Microsoft, Apple, Nvidia, Amazon, Tesla, Meta, and Google. Those stocks comprise over 50% And that has to do with diversification in the Qs versus the SPYs, which is around 25 or so percent. Again, 50+% over here, 25%. And in the IWM, none, zero, no percent. The monsters of tech don't exist in the Russell. That's why you're getting the split. And that's going to continue playing within these sectors as well. So individual stocks are impacted like the weaker ones in today's session. Now, in the weakness of the stocks, AXP is a financial, but we go down to AMD. Advanced Micro is a technology stock coming down from the 100 per share level. That's what we would be expecting. Qualcomm is also trading down after its rally. Google, large market cap Google, had inflow of money into it during the financial crisis, but now the money is flowing out. Think of it as risk off. When the market goes up and they pull money from the risky assets, and risk on when they remove it from the risky, the safety of bonds, which bonds got the bounce, and gold. Gold got the bounce as well. Again, technology, gold, and the bond market, generally speaking, were beneficiaries of the panic that sent investors into the safety of bonds, gold, and not something we say a lot, but into the safety of the NASDAQ and safety of the tech sector. As it unwinds, we are seeing the bond market trade lower. We are seeing gold, generally speaking, trade lower. And we are seeing, again, it all goes together, the NASDAQ and technology shares trade lower. And that is what we're keeping our eye on throughout the rest of this week and beyond. In terms of other sectors, just thinking sectors, again, the XLY is a discretionary. It is, the way I see it, roughly speaking, in the middle, and there would not really be a trade off the middle. I would like to trade long off of support when there is a distribution, like a little bell curve. So short or bear opportunities come from above, and bull or long opportunities come from beneath. That's what we're getting in XLF to go long, potentially to play back toward 33 or a little bit higher. Or short or bearish against resistance in the technology sector. But outside of those, where are the other sectors? I would keep my focus on those and the split between them and how it affects the Russell, the NAS, and the S&P. But industrials are in a wide range with potential to go a little lower if these things trade to the mean. The mean is just under where we are. Material stocks are back at the mean. The mean to me is the middle. So there's not an opportunity to trade at the middle. The game for this swing trading style is mean reversion. If the mean is to be found here, then opportunities play long off of lows with call spreads or call options, maybe even preferably short from range highs to get the mean being the middle. If you're at the middle, that is the same thing for fundamental valuation of stock is fairly priced. And if something is fairly priced, there's not really a good edge-based opportunity to buy it or short sell it. It would be down to some other type of analysis. But if something is fairly priced, it doesn't generate, to me at least, an edge by trading it. Be patient to short from above or possibly even go long from beneath. Energy is the wild card that joined itself with the financial sector. So crude oil is part of the XLE, or at least the XLE energy shares. Chevron, Texaco, and the others are tied directly to what crude oil does. And in the financial crisis, crude went just about straight down with the Russell. And as the Russell is rebounding, crude is rebounding as well. So that's something we're watching closely. Otherwise, P is going to be consumer staples. Again, opportunities to play short from above or long from beneath. When the market is at the middle, that's the midpoint, it is fairly valued. There's not a trade opportunity for me. V, however, does look similar to the XLF, in which case trading opportunities could be from the long side, just as other opportunities from the short side, if the mean is seen around 134, up from about 125. That's the play we're watching, at least in the XLV for healthcare, and that's general healthcare stocks. If you ever want to take a peek inside the healthcare stocks and see exactly what opportunities might be there, if you don't want to trade the ETF, then you can always go to the Analyze tab and jump into these ETFs and the holdings and the weighting and see if those stocks might fit your criterion for a trade. Finally, XLU, NE, which is NextEra Energy, Southern Company, Duke Energy, and others, has a similar buy opportunity for a mean reversion. And that mean reversion could take it again up away from the 64 or slightly under, back toward this 70 or so per share, just to get mean reversion. That's only playing the extremes and watching the market with respect to prior highs and lows and opportunities from playing, in a sense, a contrarian play, but it's just a mean reversion play. If something like a rubber band is pulled away from the mean, it tends to snap back to it, and there is a trade opportunity that often arises in that world. As always, be careful and safe in your trading this week and beyond. On Thursday, we're going to have the U.S. the PMI, the Purchaser Managers Index, and on Friday, PCI, more inflation data. Things could get volatile on Thursday and Friday. But until then, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for March 28th, 2023.